Brad Williams, Frugal Finance, swaps. There's about 30 sessions, so I'll get started here. Types of swaps. There are a lot of swaps. Wall Street, their job is to create products, and this is just a summary of products never ending, okay? They're going to come up with some creative stuff. I have not updated this in a while, so I'm sure there's some really nifty different types of swaps out there, but I will just mention a few. We got floating rate notes, we got plain vanilla swaps, amortizing swaps, accreting swaps, seasonal roller, off market, forward, extension, cancelable, basis, commodity swap, pay fixed currency, receive fixed, floating rates, and this is just a summary view. And let me just give you what the definition of a few of these, all right? So a plain vanilla interest rate swap is the most popular, is like an agreement where one person agrees to pay a fixed amount of money at regular intervals while the other person agrees to pay an amount based on changing interest rates. Even though the amount might change for the person paying based on the interest rates, they still calculate it the same way each time. Sometimes the swap can be changed a bit. For instance, in an amortizing swap, the total amount of money being dealt with gets smaller over time. This means the fixed payment and the payment based on interest rates both decrease gradually, especially if the interest rate stays the same. This type of swap is used for managing the risk that comes with mortgages, where the amount you owe goes down over time. On the flip side, there's something called an accreting swap, where the total amount of money being swapped increases over time. This is handy for projects like construction, where more money might be needed as the project progresses. For example, if a builder needs an extra $10 million every year for 7 years during a building project, they might use this type of swap to lock in a fixed interest rate for each year's worth of extra financing. Besides changing the total amount of money involved, swaps can also be customized in terms of how payments are made. In a regular swap, the fixed and floating payments are based on the current rates when the swap starts, but sometimes people might want to tweak this. For example, they might agree to pay a higher fixed rate than usual in exchange for a lower floating rate. This can involve some extra payments to make up for the difference in rates, so it's like a mix of a loan and a swap agreement, where one side might give a bit of extra money to the other side to balance things out. A forward swap is an agreement where two parties decide to start exchanging money at a later date. This can involve trading interest rates, currencies, goods, or stocks. For example, one party might agree to pay a variable interest rate, like SOFR, in exchange for a fixed rate in 2 years, and this exchange would last for 5 years. If the agreed rates match the expected rates at the start date, no money changes hands at the beginning. But the rates don't match, one party owes the other. An extension swap is a special kind of forward swap where parties prolong an existing swap agreement. Say, in the middle of an interest rate swap, one party wants to keep it going for 3 more years. If they agree to do this based on the expected rates at the end of the current swap, no payment happens when they make this agreement. In a typical interest rate swap, one party pays a fixed interest rate while the other pays a variable rate. In a basis swap, both parties pay variable rates, but based on different measures. For instance, if the SOFR rate is 6% and T-bill rate is 5.25%, one party might agree to pay the T-bill rate plus 0.75%, while the other pays SOFR. These rates are usually moved together, but the difference between them changes based on how risky banks and U.S. Treasuries issues are perceived. If the difference widens, the party paying the T-bill rate plus 0.75 benefits. And if it shrinks, the one paying SOFR does. If rates rise but SOFR rises more, the SOFR payer might end up paying less. A yield curve swap is a way for two parties to exchange payments based on different interest rates. Let's say one party pays based on short-term interest rates, like the 3-month T-bill rate, while the other pays based on long-term rates, like a 30-year bond rate. If long-term rates start higher than short-term rates, a swap might benefit the party paying based on the long-term rates when the yield curve flattens or becomes more equal. But if the curve steepens, it could help the party paying based on short-term rates. Sometimes these swaps are done using constant maturity swap, CMS. This means using rates for bonds with fixed terms, like 5 or 10 years, as a basis for the swap. For instance, someone might exchange payments based on 3-month SOFR rates for payments based on a 10-year treasury. These swaps are useful for financial institutions, especially those with long-term investments and short-term debts, like a financial institution. Imagine a savings and loan that takes short-term deposits but lends money for longer periods. If short-term rates go up compared to long-term ones, the institution could lose money. To manage this risk, they might enter a yield curve swap where they pay based on long-term rates and receive payments based on short-term rates. This swap helps protect the institution from risks related to changes in the yield curve. This is just a brief introduction. We're going to evaluate how all this works and why the swap market is a multi-trillion-dollar vehicle. Frugal Finance, Brad Williams, signing out. Thanks for watching.